Hello, everyone, and welcome back to the all-new Blueprint Strategy course. And welcome back to Module 4, Market Timing. And today we're going to just continue where we left off last time. So we're going to continue covering our zone qualifiers. In the previous lesson, we covered 3 of our zone qualifiers already, which are some of the most important ones. We covered Rule 1, 2, and 3, which was departure, which was looking at the leg out, ensuring it's an explosive, strong move out of the base. We covered the Rule 2, which is base duration, which we use to look at the quality of the base, making sure there's not too many candles there. So we had 3 candles here in this example of the Dow Jones, which was within our set of rules. Here we also applied my personal rule to further pinpoint the base or the origin of the formation. And that rule is we use the first indecisive candle that is following the leg out. And so we use this as a proximal, which is going to be the entry, right? Our pinpointing our base, and hence it's an important rule. Pinpointing our base is important because our base is going to give us our entry on the proximal and our stop loss below the distal. So the departure is important because it allows us to see where those institutions may be positioning themselves, right? This gives us an indication of, hey, there may be institutional footprints somewhere. And the base of the formation gives us then the indication of, okay, where's the origin of those institutional footprints? Where may they be? And so both of those parts of the formation are extremely important. Hence, we have additional rules and we're ensuring quality. And with an explosive move, we're ensuring quality of the leg out. With the base duration, we're ensuring quality of the base, as well as trying to pinpoint further the origin of the base, which is going to give us strong entries and safe stop losses. We also looked at freshness, and freshness is looking right to the zone. So if this is our zone, then we're looking to the right. And we concluded that this is a fresh zone because price has not tested this zone even on the wider version. What we're going to cover now is going to be originality. And originality is working hand in glove with freshness. However, rather than looking to the right of the zone, here what we're going to do is we're going to look to the left of the zone to see where the origin may be, or whether this one in specific is the origin. Okay, this is going to help us to further understand a little bit of the context of where price may be going and where price is coming from. It's always important to ask these 2 questions. Hence, we're looking at freshness as well as originality, because we want to understand where price may be going to see and find future trade opportunities. But to do that, we also need to understand where is price coming from. Okay, so originality is more of the question, where is price coming from? As we look at freshness, we're gonna say, okay, where price may go in the future, because freshness, this is fresh. So we can say that if price is gonna go there, we can argue that since it's still fresh and it's meeting all the rules, we're at least gonna get a bounce. And we can say that in the future, if we get down there, price may rally. While originality is really asking the question, well, where is price coming from? And maybe there's going to be some demand zones to the left that may be the origin of this move as well as this move. Okay, so let's first jump into the slides, and then we're gonna jump straight back into our practical applications with spending as little time on the slides as possible. So freshness versus originality. Freshness, as we understand, is we look to the right of the zone that we identified, and our rule is that the zone cannot be tested. Originality is we look to the left of the zone, and what we're checking is whether that zone or that level that we've identified has been caused by or isn't a reaction of another level to the left. So the question that we're asking is, where is price coming from? Or in other words, has another zone to the left created the zone that we identified as fresh that we're currently looking at? And so there's going to be a non-original as well as original zones. A non-original zone would be a zone that has been caused by another zone to the left, while a original zone would be a zone that is the origin. So let's go back into our example of the Dow Jones. Let's make this a little bit bigger so that we can all see. So this is our zone right there. It so far meets all of the criteria, all of the rules. And now I'm going to look to the left. Okay, so this is my zone. I'm going to look to the left. And what I find is another demand zone. So I find a drop, base, rally. So if I'm going to put this zone in right here, now what I can see is that this zone right here, the ones that we're looking at, that is fresh, however, is non-original. It's non-original because it's just a reaction of this drop base rally to the left. Now, if I'm going to look further to the left, let me just put a horizontal line here just to see where price may be coming from. So this is our zone at the moment. I'm going to look further to the left. And what am I spotting? I'm spotting another zone right there. So here I have another rally, base, rally. So now I have 3 zones. And if I'm checking this zone and I look to the left, what I'm going to find is I'm actually going to find supply or maybe a little bit of a pivot area here. So I have a rally, base, drop. And then I have a rally, base, rally. And then I have a drop, base, rally, and another rally, base, rally, or drop, base, rally, however you want to count this one. So the conclusion is this first area is non-original. The second area is non-original. The third area, that's our original zone. Okay. So what we can see is that our original zone has created this zone, because we clearly can see that price came in, there was a reaction, then we created another drop base rally, and that this drop base rally then created this zone. So the question now stands, or that's left to answer, is, well, is that good or bad? Because in this case, we could say, well, If all the orders are here, then they have been filled, then they have been filled more, and then price rally. So there's still going to be unfilled orders there if price comes back. In this case, I would argue that originality is not going to bother us too much, because what this means in this case is that the buyers are in control. Demand is in control. So the buyers come into play here. They push price higher. They create demand in the process. Price comes back. Again, the buyers are in control. They push price higher as a result. So it means that the buyers are in control. So this not being original, this being non-original, in this case is not a big issue, because in this case it just means that the buyers are in control here. Okay, so it's not non-original. It's just something to further identify, to further understand where are we coming from, and therefore where are we going to go. In this case, I would even say, well, it's rather a good understanding of price. It's rather positive that the buyers are in control, right? That we're not going deeper into the zone, because the buyers are pushing this higher and the buyers are pushing this higher, and we're creating new demand in the process, which is also the case of if, for example, let's say we have a bell curve here, then of course within that bell curve, we're going to have trends that are forming. And as long as we are arguing an uptrend, originality does not really matter. We're going to have to buy the non-original zones to get into price to benefit from this potential bell curve here. The interesting part is, however, that the area where the end of the band takes place most likely and most often comes from original strong demand areas. Okay, so this original area created the end of the band. If we can trade this here against the trend on the end of the band, if we don't see it, then we're going to have to wait until demand is formed. Once demand is formed, those demand areas cannot be original anymore. They have to be non-original. That's not a problem though, because we're predicting price to go higher. Okay, so for as long as you're predicting price to go move within an uptrend, so anticipated uptrend or uptrend, not an issue. Buying in demand is not an issue. Let's call this non-original demand zones. However, if there's anticipated downtrend, or if there is a downtrend, then buying in demand is not allowed. Okay, so buying in non-original demand zones would not be allowed. And so, as you can see here, for example, here we could argue that we're in a downtrend, right? So if you're going to buy any of those non-original demand zones, most likely they're going to fail because you would be trading against the impulse. So you want to trade at an original area if you're trading against the trend. However, if we're now anticipating a new uptrend to be formed, then we can and we have to look at the non-original demand zone. So again, it depends on the overall context of trend, how we're going to rate our non versus our original demand zones. Now, original demand zones, we can buy regardless of trend, right? So here we have an original one, the blue one, and we were in a downtrend. This one we could buy regardless of trend. Okay, however, as it becomes non-original, we're only going to buy those if we can also argue a change of trend and anticipatory uptrend. And the same would be true for supply, just the other way around. So let me just also write this down. Anticipated downtrend or a downtrend, it means that selling in supply and non-original supply is not an issue. However, if there is an anticipated uptrend or an uptrend, then selling in supply is not allowed. Original supply zones, we can sell regardless of trend. Now, I can also give you a very easy, and take a screenshot of that. We can also put some very easy rules around what is original and what is non-original in terms of the formations that we find. Okay, so our U-shapes, so our rally base, drop, and our drop base rallies. So this is a drop base rally. This could be a drop base rally. This is a rally base drop. Our U-shapes, they are most of the time non-original. Okay, they have to be most of the time non-original, because if something drops into something, right? If here we're dropping into price and then price turns all of a sudden, very likely that there was demand to the left where price turned from, right? Well, because otherwise, why would price turn? So most of the time, U-shapes are going to be non-original. There's one exception to that rule, which is all-time high rally-based drops are original, and all-time low drop-based rallies are original. And now that's also interesting because, of course, if price is gonna drop here and then gonna create demand in the process, and I'm gonna look to the left, and this is an all-time low, there's no demand to be found here, right? Because it's empty space. Then this has to be original, even though it's a U-shaped formation. So very simple. We can always just remember that U-shapes are usually non-original unless they're placed at an all-time high or at an all-time low. The counter to that is that our rally-based rallies and our drop-based drops, so here, for example, we have a rally-based rally, they are usually original. Okay, they're usually original. Now that is interesting. And then the next question is, well, why are they original? Well, they're original because if I'm looking to the left and something has already rallied and then it's basing and then it's further rallying, very likely that if I look to the left, I'm going to find supply in the process. Okay, so here's a supply. Here's a little bit of a supply rally-based drop. And so there was a rally-based rally formed in an area of supply. Which brings me to the next slide, which is going to be original flip zones. A flip zone is a new demand zone that's formed in an area of original supply or just supply in general, and or a new supply zone that's formed in an area of original demand or just demand. So usually flip zones are original. Usually flip zones are rally-based rallies and they're drop-based drops. The interesting thing about flip zones is that they are usually extremely strong because it shows that one force is clearly in control, because one force, either the buyer or the seller, took out the other party at an area where previously the opposing party was in control. So there was supply before, which meant, okay, the sellers are in control. And then the buyers are pushing through supply. And in the process, they're creating new demand, which means that the buyers have now, there has now been a switch of control. And now the buyers have gained control. And those original flip zones tend to be extremely strong. So in this example, we could argue that this original zone is also a flip zone. It's a flip zone because price has switched the control from the sellers being in control, pushing price lower, to the buyers being in control, pushing price higher. And as price comes back into this area, we see more orders being filled and price again pushing higher. So extremely strong area here, flip. So this is original flip. This here is a non-original zone, and a non-original zone most of the time also cannot be a flip zone. Okay. There is going to be my own personal rule that I apply to flip that goes outside of supply and demand as well, which is, however, going to be more of an all-encompassing lesson, because it would involve trend lines and channels and trend formations. So in this case, I had a downtrend, and if I'm going to draw a trend line here, And that trend line, I understand, is going to be messy, and I don't care too much. However, what I understand is that this is the area, if we come back here, that this is the area where price managed to break out of this downtrend, and a retest of this would imply a flip of control, right? So the flip level is nothing else to me. The advanced rule, my personal rule, is a flip zone is the flip of control. Who is the stronger hand at the moment? Are the sellers the stronger hand, or are the buyers the stronger hand? Now, the area where that flips from the buyers being in control to the sellers being in control, or vice versa, these are flip zones. Now, flip zones, they can be non-original and they can be original. The textbook understanding would be that flip zones can only be original, right? That's the easy understanding of what a flip zone is. The more advanced understanding of what a flip zone is a zone where the control of price flips let's put it this way. A demand flip zone is a zone where the control of price flips from sellers to buyers. Is a zone or an area and a supply flip zone is a zone or an area where the control of price flips from buyers to sellers. And so these flip areas are extremely important to us, because as we look at the bell curve, we want to try and catch that bell curve, that up move, as early as possible. And so where that flips right here, where that flips is the area that if we get a pullback, we want to be in as early as possible so that we can then ride that entire wave to the upside, right? So it's going to be those flip areas to us that's going to be important, because we want to be in this for the big run. And so this can be identified with so the classic example here is, and that's the textbook version, is identify flip zones with supply and demand only, right? So an area of demand in an area of original supply. So there was supply previously, now there's demand, and vice versa. There was demand somewhere and now there's supply. So you're just looking at supply and demand to see where those flip zones are. The more advanced way is, and that's my personal way of arguing flip zones, is identify flip zones with the above, as well as with trend lines, trend formations, and structures. And what we can also use is pivots, previous pivots. Okay. So this is my personal rule. And that makes a lot of sense now, right? Because I have a pivot here because I had a downtrend. So I had a pivot here and I had a pivot here. Now we broke those pivots. Now this is the area where we broke those pivots, and the origin is kind of here. If I put a trend line down here as well, this is the kind of origin of where we flip control. In this case, this is an original flip based on supply and demand. However, it's also a flip based on, for example, the trend lines, right? So I have a trend line here. I have 1 test, 2 tests, 3 tests. I stay below, and then we flip, we break it. So this is again the area where the control switches. So it has to be an original, even if it wasn't also original based on supply and demand. It has to be original because there was one force in control. Here's the pivot. Also, this is another pivot. This was broken right here. And we can see that here already we got price, even testing this flip pivot point. So there's a flip pivot. Here we broke the flip pivot, then price comes in, test this, goes higher, but there's no demand, then price goes into demand. That's also the flip for us. And then in this case, we finally get the move, and price moves higher and creates a new flip here in the process. And so if within rule 4, we're looking at originality and flip, I would say yes. Okay. It's a non-original zone, but it's a flip. Okay. So what we're trying to do here with our rules, we're trying to get as many rules ticked as possible, right? The more rules are ticked, here, for example, all of the rules would have been ticked: departure, base, freshness, originality, flip, right? The more rules you get booked here as a yes, the more probability you have that this small zone is actually going to work out, and probability as well as profitability, because you're ensuring quality of the zone too, right? So we're really being scientific here. We're adding a lot of rules. So there's going to be 2 rules that we add when it comes to originality. We're going to look at originality from a standpoint of supply and demand. And here we can say that U-shapes, they're usually non-original. The exception to that is that all-time high rally-based drops are original. All-time low drop-based drops, they're also original. So whenever we have U-shapes in all-time highs or all-time lows, they're gonna have to be original. And rally-based rallies and drop-based drops, they're usually original as well. Then we also look at flip zones, and a flip zone is a zone or an area where the control of price just flips from sellers to buyers. A supply flip zone is a zone or an area where the control of price flips from buyers to sellers. And so the textbook explanation here is just identify flip zones using supply and demand. And the advanced one is we use all of the arsenal of tools. We identify it with trend lines, with trend formations and structures, and with prior pivots. So I would suggest you take a quick screenshot. What I want to cover next is I want to skip a few zone qualifiers and I want to get on to level on top of level straight away. Because as we cover now, also our level on top of level, this kind of goes hand in glove with freshness as well as originality, because we're going to look for multiple levels for coverage. And so while we're looking for originality, we can also look for level on top of levels anyways. And as we're covering then those 5 rules, you have, I would say, 90% of the job would be done, right? 90% of the job, if not even more, the most important things would be done, because we've already done so much, right? We looked at the leg out, we looked at the base, we looked at freshness, how many unfilled orders are left, we looked at originality, and we looked at flip. So now in line with that, we're going to look for level on top of level. And then if we find a level on top of level, that's going to help us in terms of safeguarding, okay, an additional safety net, more coverage, because if we have more levels below, it means that we may need additional safety, additional coverage for our stop loss. We know that our proximal lines at the moment are going to be our entries. And we know that somewhere below the distal are going to be our stop loss, okay? So the issue now, as we're identifying this, our stop loss, I don't have an issue with our entry, it's solid. The issue comes with our stop loss, because our stop loss is right within a zone and right within another zone. So where are we going to put our stop loss? We also can't really put it here, right? Because if we put it here, then our zone just doubles in size. And so if that's the size of our zone, if we take the full coverage and that's -1, then price has to travel all the way to here to just create a +1. And price has to travel all the way to here roughly. I'm just eyeballing this now, to create a 2. So to create a 1 to 2, price has to make a big, large rally. However, if we could maybe further refine the entry and further use a safe stop loss, and maybe we would end up with something like this as a new one, then the same scenario here, I would make a +1. Here I would make a +2. And then here I would make a +3. So maybe overall I would make, with the same example, a 1 to 3.5 by just also using level on top of level. So what we're doing with a level on top of level is we're moving within that yin and yang, right? Where we want to be safe, but we also want profitability. So safety in terms of stop loss, but also profitability. And so that level on top of level kind of allows us to operate here, where we have the perfect trade-off between both of them. Because if I am just safe and I'm struggling to make profits, that's not good. If I'm just focused on profits, but I'm not safe, it means I will get stopped out too many times. That's also not good. So I have to kind of be here in that middle. And how do we do that? We do that by looking at level on top of level, which is going to be the rule number 5, and which will also conclude the lesson today. So since we've already looked at originality, we can also do this. And the level on top of level is such an important analysis that I've added it as an additional step of the process here, where we have the location, the direction, the zoning, and now also the level on top of level, which we use to refine the set with maximum coverage, right? That trade-off between profitability and safety. Always safe. The priority here is always on safety first. So just a pure definition of a level on top of level. There are many cases where we have multiple levels on top of one another, right? That's true more times than it's not. The reality of charting is that we'll find many levels, and when they are on top of each other or intertwined, then it's a level on top of level. So it implies that there are also more unfilled orders potentially. And in other words, if there are more unfilled orders, it also means there may be a higher probability of getting filled. However, it also means that it makes our lives in terms of timing the market a little bit more difficult. What I don't want there to be is, 3, 4, 5 levels just on top of one another. That just means I have no ways of timing the market. I've no way of identifying which zone is better than the other than maybe the location of the zone, whether it's covered by the big brother or not. So there are going to be several ways of trading this. There's not going to be a right or wrong. I am going to give you a recommendation, a default setting. However, you can choose to deviate from that default setting from times to times, okay? The most important is that we have a consistent approach here. But let's move on to the definition in terms of the technicals, okay? So if we have two zones, here we have a rally-based rally and a rally-based rally, we will have two levels on top of each other. Let's call them proximal level and distal level. So an upper level and a lower level. Now, if the proximal level is A, and the distal level is B, then what I'm interested about is that space in between. And that space in between has to be smaller or equal to either of the two. Okay, so the space in between here, the white space in between, or in my trade station, the black space in between, has to be smaller or equal to either of those two zones. So our first zone that we identified below current price has to meet all of our zone qualifiers, all of them, right? All of them that we want to be met. Once we identify a distal level, that distal level only has one rule, and it's not even a rule. So it means everything that looks like a level is a level. So really what we are using the distal level for is that additional coverage in terms of potentially placing our stop. But I also know that I can't place my entry here and my stop loss there, because then my zone just would be way too large. And so there will be maybe a trade-off on how we're gonna approach this. So there's gonna be 3 approaches. Let me start with the first one, because that's just what we covered also in our example. If I'm going to enter price right here with a stop loss below the lower level, so I have the full coverage, perfect, and I have the highest probability of getting into that trade. However, I have the smallest profitability, okay? I have the smallest profitability. but I have the best probability of being in this trade. If I'm just dividing this zone and I'm saying, well, I'm going to put 50% at the proximal, 50% at the distal level of the proximal. So I would have an entry here, 50%. I would have an entry here, 50% of my position size. Both those positions I would use a stop loss down there. I would still have the ideal coverage. However, now my overall entry, the average of the entry may be lower. So I get a better profitability, but it may also mean that not my full position, that my full position size may not be filled because price may only go here. It may not even fill my second entry, and then it would go higher. In this case, I would technically have more profit, but I would even walk out with less profit than with scenario one. So therefore, this scenario for me just completely goes down the drain. I'm a believer of I teach you what options there are. I tell you what I do, but I also give you a recommendation, but I'm not gonna sit here and say you have to do something, right? I want to give you the options, and then you have to decide on your own which one may suit you the best. In this case, it's kind of like an averaging in kind of scenario, and I like that the least out of all of our three scenarios. This here I like the most. I tell you why. Here we're using a combination of a refined entry, but a safe stop loss. So I have full coverage and I'm going to buy at the lower level. However, I'm not going to buy at the preferred. I'm going to buy at the wider version of the lower level. Okay, so here I also have a pretty high probability of getting filled. This is just based on experience. A lot of times what we see is that price goes down into the first level, bases a bit, fills some orders, goes lower, and then continues to move from there. So, and oftentimes when this happens, price does react to the wider version of that lower area because it already took out quite a lot of sellers, and then a weakening selling party is meeting new demand, and then usually the demand at that point would just be completely in control, and then it's the wider version that most of the time we already get a reaction from. So here we have that perfect yin and yang trade-off between profitability and coverage and probability of getting filled, right? So there's always these three: probability of getting filled, which here is gonna be less than here. Then we have the profitability, which here is gonna be more than here. And then I have the safety, which here I have on both. So the only question is, what do you want? Do you care about just being in this trade and you care less about profitability? Or do you care less about being in this trade, but more about profitability? So in some cases, you may have scenarios where you can do this and it's still fine because they will be close together or they will be intertwined. In this case, it's fine to do this, but in most cases, they're quite far away from one another, and the area would just become too large. And then even if we traded this, we would struggle to make a solid profit off of this trade, and then we would just use this option. So it's either we use this or we use this. Very, very rarely I would use this one. And that's depending on what do I see? Do I see enough profit margin? Do I see enough upside or downside potential based on the analysis that we've done? So here's the level on top of level rule. the entry is at the wider version of the entry is at the wider version right here, and the distal, we use a standard stop loss of 33%, which just gives us additional coverage. So we have an entry on the wider and a stop loss below the distal. And why do we do this? It's based on historic trades. Most of the time, price does hit the second area. It does hit the wider version of that second area. That's the most profitable. That's the scenario where we have the best yin and yang of risk to reward versus probability of getting filled, and then also accuracy because we have a safe stop loss. What we definitely do not want to happen is just setting the first one and then having a stop loss right there. And then what's going to happen is price comes in, stops you out at that stop loss just to fill the wider of the lower and then go into that direction. So that's something that we're not going to do. We're not just going to trade the first one. We're going to take some coverage of the second one, if not full coverage, and then we're going to enter it on the wider and to still have a better probability of getting filled rather than here, which then probability of getting filled would be rather low. Here it's medium, here it would be high. And so we're kind of going with the medium approach here to have an opportunity where we have the best yin and yang. In this case, we may not get filled in this in the trade setup, and that's okay. We just, sometimes we're going to miss trades. We have to learn to live with that. So let's go back to our example here. And on our example, we identified this as our level and non-original zone, but that's a flip zone based on the advanced rules. So here is another level. And so I already have a level on top of level. I have a level on top of level. And this means that I may want to cover myself with a stop loss below that level on top of level. I even have 3 levels on top of one another, but in this case, we would look at that flip zone, at the buyers to be in control. We wouldn't argue for price to go all the way down here, right? Because then price would make a new low. Wouldn't make sense. We're arguing to the bell curve to continue. However, we may want full coverage in this trade. So I'm going to remove this one just so it's a little bit clearer. And what I'm going to do with the level on top of level now, I could say, well, my entry now is, I have 2 options, right? I could take the first an entry here, and then a stop loss below everything. And what I could also do is I could now have an entry here on the wider version of the second level with the same stop loss. The question now becomes, where do I have more profit? Of course, with this one, right? So where do I have more probability of getting filled? Of course, this one. How desperately do we want to be in this trade? Very desperately, okay? Very desperately. Do we still have enough profit margin on the way up, even if we take the higher entry? Yes, we do. Okay, so we've gone through now a couple of questions to check. Is it okay to trade the first entry? Yes or no? What would not be okay is to have an entry here, for example, right? To have an entry here, because if I had an entry here, then that would imply that this is my zone. So then I don't have any risk to reward proposition on the table. So that's not okay. Both green scenarios are okay. And then you just can argue either way. They both would be completely correct. I would personally put the green as an entry, the light green as an entry, and then the full coverage here. And so there's going to be different kinds of levels on top of levels, right? So you may find a level on top of level like you find here, which is a drop base rally followed by a drop base rally. And most of the time, because they're both U-shapes, they're kind of intertwined with one another. In this case, very often, because they are intertwined, I will put the entry on the first one and the stop loss below. I just combine them, right? Here we're combining them because they're intertwined. So whenever you have a level on top of level that is intertwined, you can combine them as one. Rather than trading just the lower one. However, if you have an example like a rally base rally and then followed by a drop base rally followed by a rally base rally, and there's quite a lot of white space in between, then what you're going to do is you're going to use the wider version as an entry, and you're going to take full coverage. Okay, you're going to take full coverage. The same you're going to do if you have a rally base rally base rally. Okay, if you have a rally base rally followed by a rally base rally, always take the lower on the wider version and cover yourself with the lower as the stop loss. So there's only one way where I would combine is when they're intertwined, and usually when they're intertwined, it comes with two U shapes, right? It comes with two U shapes, and the two U shapes could also look like this in a supply example. So we have a rally base drop followed by a rally base drop. In this case, they may be kind of intertwined with one another. It's okay to take the entry here and full coverage. However, if we have a rally base drop followed by a drop base drop, we just take the wider version here as an entry, stop loss below. And if we have a drop base drop followed by a drop base drop, here also always put an entry here and a stop loss below, right? So these are the 6 scenarios, and the only scenarios where I would go with the combined is the U-shaped combination, where we have kind of an intertwined level and I want full coverage. Any other time I would just use the lower, the distal level as an entry on the wider version with a full coverage stop loss. So what I then can do is, well, it's going to be very simple. I can put my distal now down here because I'm combining this all. And what you can do is and we cover this more when we talk about trend management, on your stop loss, you can just add a minus 33, make it a red line, dotted, and here you would then have a minus 33 stop loss. Now you would have your entry right there. And later we're going to add targets to that as well. So it's going to be automized. Our 100 is always our entry. So our entry, you can color code this to make sure that you don't switch up the lines, right? Because if you switch up the lines, then if you put it like this, then you're like, hey, why is that minus 33% here? Well, it's because the 100 always has to be the entry, right? The 100 always has to be the proximal, and the 0 always has to be the distal. And so if you color code them here, you can ensure that you're placing the lines correctly. Then you can add this as a default. And if you are putting in a supply zone, for example, then you can see now the proximal is the lower line, the green line, that's the entry, and the distal is up here. And you can see that this way the stop loss is above the zone, which it should be, right? So when we talk about trade management, know when to hold them and when to fold them, we're going to speak about why we need the 33% and the different target areas that we can also preset as default. So I'm going to switch the 33% off again, and I'm going to set it as default like this, so that when I'm drawing a new zone, I always have my areas without the stop loss, because the stop loss I only want to add to the zones that I also want to place at the end of the day. So I manually would add it right there when and if needed, so that if I'm operating on higher timeframes, for example, I don't always also have the red lines as well. And you could do this in the beginning just to help you with the 100% and the 0%, and then how the targets as well as the stop loss parameters work, and ensure that you're always putting first the proximal, then the distal. Okay, first the proximal, then the distal. That will ensure that you have the 100% first, then the 0% later, which then means if this is 100, this is 0, this is minus 33. If this is 100, this is 0, this is minus 33. Just as a side note and as a care point here. Now we've gone through all of these rules, 5 rules in total, and 90% of the job is done. So what I want to do with you next is I want to cover one more market with covering all of our 5 rules that we have done so far. Let's do crude oil. And for crude oil, it is important that we use @CL equals 103xn. The picture that you'll get is actually quite different. So I'm going to put here @CL equals 103xn. And again, if this is not familiar to you, no worries. Watch the futures course, and then this will make sense why we're using that. So before I even go into my lower time frame and into my different rules here, let me just clean this up. these 5 rules now become your checklist, and you can just copy it and paste it into your new symbols. And so you have it right there, or you have a checklist on your desk on a piece of paper printed out. And then you can make sure that you're not missing any of these quite important steps right here. So again, what we're doing is we have to start now from scratch. So we're going to start on the higher time frame, and we're going to do a weekly analysis first. Actually, let's do something else, because we've done a weekly analysis. Let's do a daily analysis. Okay, so how can you switch from weekly to daily? Well, we have to create separate worksheets for that. Okay, so I'm going to save that worksheet now as weekly income worksheet. And now I'm going to recent workspaces, or to workspaces, and I'm going to open workspace. And now I should still have my old workspace, which is just the blueprint worksheet. I'm going to open that. And this I will save as daily income worksheet. Okay, so I have a weekly income worksheet, and I have a daily income worksheet. And of course, on my daily income worksheets, the higher time frames will now be set to daily. So my higher time frame location to daily, my higher time frame direction to daily, and then my lower time frame, I will use a 240-minute as a standard default lower time frame. And here I can put in our rules, and you can see the rules won't change. It's just the time frames are going to change. And here, of course, I do want at CL equals 103xn. Once again, putting in my checklist right there. And now I can start on the higher time frame. Beautiful. So first daily, first demand already, I can see right here. Now I'm going to change this back to gray. And here we can see that we have a drop base rally. And even though the base is a decisive or even an explosive candle, it would be part of the base, just visualizing rather than putting too much science onto it. And I'm doing this because if I'm going to go to the left and down, using a horizontal to really navigate here, there's no green candle. There's a green candle, but if I'm putting this level in, this will be tested right there. So that goes down the drain. I go down, I go down. It's nothing. I go down. I would go as low as $60 mark. Okay, so I can see if I'm doing daily income and I go down to the $60 mark, and then I go up to find supply. My window of opportunity is just too large, right? Price is too far away. I'm doing daily income. I want to find trades that are going to get filled relatively quickly, right? I don't want to wait now weeks for price to get into an area that I can trade. This would be more like weekly income. But for the sake of daily income, I would use these first two, demand as well as supply areas. Now you could argue that if I'm putting the supply like this, drop, base, drop, this could be tested here, right? We have one test, we have two tests. And so if you're using the preferred version here on this proximal line, on this as a base, so 1, 2, 3 basing candles, then we have a drop, base, drop, then this would be tested. In this case, I would also be fine if you said, well, this may be tested. Let's put our candles and our distals right there. And here in this case, we don't have a test yet. So on the higher time frame, remember the test is 25%. It's not 25% on the preferred. We're not testing on the wider. So here we're quite solid, supply demand. Now, I'm going to divide this area again into 66 and 33. So I'm at the moment in equilibrium, but I'm going towards low and very low. So there may be an opportunity to buy if price goes lower. At the moment, though, hands off in terms of where price is. Now my next step is trend. So at first, I'm going to add the zigzag study, okay, zigzag in percents. And just to make my life a little bit easier here. Okay, so 1, 2, 3, 4, 5, 6, 7, 8. Okay. So what kind of trend do I have? I have a low, I have a high, I have the same low, I have a lower high, I have a higher low, I have the same high, I have a lower low, I have the same high. So to me, it looks like this is a sideways trend at first glance. Okay, are there any potential trend formations that we could anticipate? Well, if this happens, right, then I may have an inverted head and shoulders, left shoulder, head, and then the right shoulder may come into play here. This would give me a neckline right there. And that would mean that I could anticipate an uptrend. So sideways trend, anticipate uptrend with inverted head and shoulders. Now the question is, where is price going to potentially create that higher low, that right shoulder? In higher time frame demand. So we have a right shoulder that we can anticipate that is going to be formed within higher time frame demand, that may be formed within higher time frame demand. So my higher time frame demand starts right there. However, my window of opportunity starts from 71 to 60. So 71, which is this line right there, which is the low line, to 67. So now I have my window of opportunity. And within the window of opportunity, I will find demand. I will find demand, multiple demand areas. And let's just check from this line onwards. I may have some demand right there. Okay, so here I have the first demand. Let's cover this demand for a second. How about departure? Well, I have maybe a decisive candle as an alternative rule, but what I don't have is I don't have follow through. So the leg out is not really explosive. It is just decisive. And that would work if there was follow through, but there's no follow through. So already just looking at the departure and this area, I have to scratch that, right? I have to scratch that because the leg out is not very powerful. So I'm going to look lower, lower, lower. This is a very nice leg out. Look at that. That's explosive, right? That's beautiful. So I have a nice leg out. So where's the base? I have 3 basing candles here, and then I have a leg in, a rally. So rally, base, rally. So let's test that. Rule number 1, departure. We covered this already. This is a very strong leg out. It's an explosive candle. And I would look at the leg out, not just as in this candle, but I would look at the leg out as in the overall move. And this move was intense, right? Very explosive. Explosive leg out, buyers in control, follow through, and then there was even a massive gap up over the weekend due to OPEC meeting on that weekend. And then now price is coming back. So this is the first demand area that I see that meets our strict rule number 1, departure. Now base duration, we've got 3 candles in the base. They're all indecisive. That would meet the rules. It's not a lot of candles. It's not too few candles. It cannot be a speed bump because it's different shape of candles, and we're quite low in terms of the location. And rule number 3, freshness. Is it fresh? Let's test that. I'm going to put a horizontal on the wider version on the highest wick of the base. In this case, has price ever tested this area? No, right? Price has never been there. So this is completely fresh. Freshness, I look to the right. This is completely fresh. So freshness, yes. Originality. Let's check that. Let's look to the left. I'm looking to the left. Okay, here I may have something. Seems like there could have been a rally-based rally or a drop-based rally here, which means that this area could be non-original, but it could also be original if you saw it as a drop-based rally. However, in the bigger context of things, I would even argue that this is right, if we were to visualize the formation, then this would be a drop, a base, and then a rally. So when it comes to originality, also visualizing the formations, in this case, yes, here we have a rally-based rally, but overall it could also be a drop-based rally. So drop-based rallies, remember, they can't be fresh. They can be original. They're usually non-original unless it's an all-time low. It's not an all-time low because the prior low is here. So this has to be a reaction to something that happened here. So it's non-original. Is it a flip? It's also not a flip, right? There's nothing. There's no supply on the other side. There's demand on the other side. And so it's also not a flip. But these two are not criteria that would overrule everything else. It would just be an additional odds enhancer, if you will, to add quality to our zones. Now, do we have a level on top of level? Let me look below and to the left. There's just a large wick. Now, large wicks are troublesome because they make, I oftentimes refer to large wicks as noise. And this noise just makes my market timing a little bit more difficult, right? Because maybe price is going to go deep inside the wick, because wicks also imply buying pressure. Where is the buying pressure coming from? Rather from the bottom of the wick than the top of the wick, right? So with that being said, I don't have a classic level on top of level, but I have some wicks that I may want to cover myself with. So I would want to cover myself with this wick right there for sure, right? Because after this wick, let me just draw this in again. I would want to cover myself with this wick for sure. I could cover myself with this wick, but then the zone would just become massive. And that's not on the cards. So this is the best I have at the moment available to time the markets. Do I have a level on top of level? No. But cover with wick low. Right? So this is how we're going to approach it. Now, we have a stop loss. And we have an entry, and we have a stop loss. And is this a potential buy zone? Let's check where we are. Well, we know we are within the window of opportunity, right? We're within the window of opportunity because we're below this line, we're below the low. Do we also have big brother, small brother? 69.60, 60 starts at 69.60. So 69.60 is right here. So I'm below that. So I've got big brother, small brother covered as well. So this is also something that you could check here additionally. You would check that ideally below the level on top of level. Well, you could check it either way, as long as after you find your entries, your entry has to be within the level on top of level, right? If you had a first level and then a second level, if the first level is not covered, but the second level where you placed entry is covered, that would still be big brother, small brother. Big brother, I mean higher time frame coverage. Yes. Rule 6, after determining entry and stop loss. What didn't we do? We didn't look at our fundamentals, right? Okay, let's do that. Let me just open the blueprint cheat sheet. Crude oil. We're not checking the commercials. We're not checking the non-commercials. We're not checking the retailers. We could check against gold. And of course, supply and demand is going to be important. And the true seasonality is going to be quite important here as well. So when it comes to crude oil, we can also check the commercials, the non-commercials, and the retailers. Let's do that real quick. And we can check the valuation against gold too. So let's start with our COTs. What you want to do is you want to check them on the weekly. So what we have to do is for your daily income worksheets, because you still want to check the COT, I'm going to copy that and I'm going to paste this and I'm going to add it right there. I'm going to remove the drawing objects and I'm going to make the weekly chart out of it. And this chart you will use for the COT only, right? So let me just add them. So we've got the fund managers right there. And we've got the index right there too. So what's interesting already is that the commercials are buying, they're accumulating. So that's a plus. That's very interesting to see. And our non-commercials, again, are pretty low, which is great to see as well, because it means that they may have ran out of selling power, right? They're as low as they can get. So the last time they were that low was here. And we know that from here, we got a massive rally. So what we need is, we also eventually want to see that the non-commercials are breaking out here. And it may have seemed like they were going to break out here, but they haven't just yet. So maybe they still will, because the commercials at the moment are quite bullish, right? They are quite bullish. So the last time they were bullish was here. Here they were at an extreme, and here price rallied. And the only issue is that the retailers also seem to be buying, but I'm still going to go with the commercials in this case. So it's not the ideal picture, but it is pretty solid because we have the commercials buying. So I'm going to put this lower. Now we're going to check the valuation. And what I'm interested in is the 10 length cycle. Was it 10 or 30? And that's where you have the cheat sheet to put these nodes on. Crude oil, 10-day cycle, trend following, buy and sell as secondary tool or odds enhancer against gold. So what do we see on the 10-day cycle against gold? We're close to being undervalued. The last time we're undervalued right there. And that created this low right there eventually. And then we were overvalued. That created that high here eventually. And if we get undervalued again, which it may seem like we're going to get there, then this may be a good time to be buying as a secondary. However, we don't have to get there, but it would be amazing if we did, right? It would be amazing if we did. Now, last check, true seasonals. Something happened to the internet today at the office. So let me just check that on the blueprint worksheet. So where are we at? We are in June. I have to change it to, let's see if that's going to work. HCl equals 103 XN. Or if the data also doesn't load here. No, here it does. Perfect. So we are in June. So what do we see? A rally, okay? On the 5-year, it's the best. Seems like it's the most significant rally, but we get rallies across the board here on all of them. Just to 50. 50. Change this to 50. So this is where we're at right now. 7th of June. And so we should still get a rally up until July. Okay. So July, but true seasonality bullish. Change this to 1 year. So true seasonality, we just checked on our seasonality worksheet because we have some internet issues here on our charts here on TradeStation. It's having some issues to load the data. So now we checked all. We checked the COT, commercials are accumulating. We checked the valuation. We're close to be undervalued. If price gets there, very likely we are going to be undervalued. So we have now a lower time frame zone that meets all the zone qualifiers, and above all, that is within the right context of higher time frame technicals as well as fundamentals. So you can see that by simply following the steps, you should get to the same conclusion. It's very objective, it's very mechanic, and then just fine-tuning, okay, where could I put the stop loss for ultimate coverage? Could I refine the entry? Do I have a level on top of level? And then in the next lesson, what we're going to do is we're going to add the rest of our zone qualifiers. And then, of course, we're going to have a lesson around trade management as well. Know when to hold them, when to fold them. That's all from my side for today. Thanks for watching. Happy and safe trading. And I'll catch you all next week. Ciao.